For many, Thailand has long been seen as the ultimate expat paradise. But recently there has been talk about tax changes and potential closing of loopholes. Is the dream of tax-free living in Thailand fading? Well, it's true that in 2024, Thailand did introduce some significant changes to its tax system, and understandably, this caused a bit of panic. But before you decide to pack your bags and abandon the land of smiles, please take a deep breath. The truth is, living tax efficiently in Thailand is absolutely still possible. In this video, we'll examine Thailand's new tax system in 2025 and look ahead. We'll uncover smart strategies for living comfortably and, yes, even tax-free in this incredible country. For many years, Thailand was considered a true tax haven for expats. The old system was remarkably simple. If you earned your income outside of Thailand and then brought that money into the country, you paid absolutely zero Thai tax on it. However, the landscape shifted on January 1, 2024. Thailand introduced two key updates to its tax rules that you need to be aware of. The first major change was the introduction of a tax on remitted foreign income. This means that if you earn money overseas and transfer it to Thailand, you may now be subject to Thai income tax. The second significant change was Thailand's joining the Common Reporting Standard, or CRS. CRS is a global initiative aimed at increasing tax transparency worldwide. By joining, Thailand is now participating in the automatic exchange of financial information with over 100 other countries. When these changes were announced, it's understandable that many expats felt a sense of alarm, worrying that this was the end of tax-free living in Thailand. But the good news is, there are still very real and significant opportunities to navigate this new system effectively. To really understand how to make the most of the current situation, it's essential to grasp the three core pillars that underpin Thailand's tax system post-2024. Let's start with Pillar 1, tax residency, and specifically, the 180-day rule. This is absolutely crucial. The rule states that if you spend 180 days or more in Thailand within a calendar year, you are then classified as a tax resident of Thailand. This tax residency status is the primary trigger that could make your foreign income taxable if you choose to remit it into Thailand. Conversely, if you stay for less than 180 days in a calendar year, you are generally only going to be taxed on income that you earn within Thailand itself. Moving on to Pillar 2, tax triggers, and understanding when transfers actually matter. This is another area where there's potentially good news for expats. Because, crucially, it's only the money that you actively bring into Thailand that is potentially subject to tax. Any funds that you keep outside of Thailand, for example, in your overseas bank accounts or investment portfolios, remain completely untouched by Thai tax, even if you do happen to be classified as a tax resident. So, a simple and effective strategy emerges from this. Aim to cover your day-to-day spending within Thailand, using money that you bring into the country, but make a conscious effort to save and invest globally, keeping those longer-term funds securely offshore. Finally, we have Pillar 3, income thresholds. And here again, there's a degree of built-in buffer in the Thai system. While Thailand does employ progressive income tax rates, ranging from 0% all the way up to 35%, there's a very important threshold to be aware of. If your total remitted foreign income for a given year stays under 120,000 baht, which is around $3,500, then you will pay nothing in Thai income tax. Alright, so how can we practically apply these three pillars to live a tax-efficient life in Thailand? Let's explore 5 key strategies that expats are using right now. Strategy number 1. Master your residency timing. As we discussed, staying under that 180-day limit is paramount if you want to minimize your potential Thai tax exposure. Think strategically about your visa options. Using tourist visas, enrolling in education visas, or proactively planning frequent trips outside of Thailand are all effective ways to manage your days. It's also worth remembering that many Thai visa types, including the popular Elite Visa and Retirement Visa, actually have no minimum stay requirements at all, which gives you significant flexibility in planning your time. Strategy number 2, the LTR visa. If your goal is to establish long-term residency in Thailand and maintain a highly tax-efficient financial setup, then you should definitely explore Thailand's long-term resident visa. This visa, valid for an impressive 10 years, offers a truly exceptional benefit. It completely exempts your foreign-sourced income from Thai income tax, even if you choose to bring that income into Thailand. Now, to qualify for the LTR visa, there are certain criteria you'll need to meet. Generally, this involves demonstrating a substantial annual income, typically over $80,000 per year, or making a significant investment in Thai assets, usually around $500,000. The LTR visa is specifically designed to attract high-net-worth expats and highly skilled professionals to Thailand, and it's an excellent strategy for tax-efficient living here. Moving on to strategy number 3, leverage double tax agreements, or DTAs. Thailand has established an extensive network of DTAs with over 60 countries around the world, including major nations like the United States, the United Kingdom, and Australia. These double tax agreements are designed to prevent you from being unfairly taxed twice on the same income, once in Thailand and again in your home country. Furthermore, these treaties can also work to reduce the overall tax rates that you might pay on certain types of income, such as pensions, dividends, or royalties. For example, imagine a U.S. retiree who is receiving pension income and chooses to live in Thailand. Under the DTA, they may be able to pay Thai taxes on that pension income, but then claim a foreign tax credit back in the U.S., which could effectively offset the Thai tax liability. Strategy number 4, bank smart and strategically keep funds offshore. This is absolutely a key strategy for tax efficiency in Thailand. The core idea is to utilize international credit and debit cards that are directly linked to your bank accounts held outside of Thailand for the majority of your day-to-day spending within the country. While technically speaking, these types of transactions could potentially be classified as remitted income, the current reality is that enforcement in this area is generally quite relaxed. And finally, strategy number 5, carefully time your transfers. If you anticipate needing to bring larger sums of money into Thailand at any point, it's wise to be strategic about when you make those transfers. One excellent approach is to prioritize spending any savings that you accumulated before the 2024 tax changes came into effect, because this old money continues to be treated as tax-free, even when brought into Thailand. Now let's address the elephant in the room. Enforcement. Yes, the Common Reporting Standard, or CRS, is in place. And yes, in theory, the Thai Revenue Department could potentially track financial activity in your offshore accounts. However, the practical reality on the ground is that enforcement of these new rules, particularly as they apply to typical expats, remains relatively limited at this time. Just think about everyday transactions. If you use a U.S. credit card to pay for your hotel bill during your stay in Thailand, that technically constitutes a remittance of foreign income. Yet in practice, it's unlikely that this will affect foreign residents. These 2024 tax reforms were primarily designed to target wealthy Thai individuals and corporations who were perceived to be evading domestic taxes, rather than to aggressively pursue expats living in Thailand. So what's the final verdict? Thailand remains a remarkably tax-efficient destination for expats. The rules have tightened, but with informed and strategic planning, carefully controlling your residency days, exploring the advantages of the LTR visa, and strategically keeping your income streams offshore, the dream of paradise, combined with genuine tax efficiency, still awaits you in Thailand. We strongly recommend that you always consult with the team at Liberty Mundo, who can provide personalized advice tailored to your specific financial situation and residency plans. Tax laws are inherently complex and constantly evolving, so professional, up-to-date guidance is truly priceless. If you found this video helpful, please give it a thumbs up and be sure to subscribe to our channel for more essential information on living overseas, second citizenship, and asset protection.